Hey everyone, I'm glad you could join me today. We're diving into a topic that could have a significant impact on your paycheck, your retirement savings, your grocery expenses, and even the safety net you and your loved ones rely on. The new tax bill proposed by the Trump administration. This isn't just a few minor adjustments. We're looking at a major overhaul that could fundamentally alter how Americans are taxed, how federal programs are financed, and who stands to gain the most in the long run. Did you know that if you make under $30,000 a year, you could actually end up paying more taxes with this new bill? If that comes as a surprise, you're definitely not alone. Many people hear tax cuts and think more money in my pocket, but the reality is more nuanced. So if you're curious about whether this new plan will help you or hurt you, stick around. We're going to break it all down step by step, so you can get a clearer picture of what this means for your future. Before we jump in, I'd love to hear your thoughts. What do you think about this new tax bill so far? Drop your comments below. And while you're at it, consider subscribing to stay updated on topics like this. I aim to keep things straightforward and highlight what's really at stake. Now let's get into what this bill is all about. Officially titled the One Big Beautiful Bill Act, it spans over 1,000 pages. But don't worry, you don't have to read every single word to understand how it might affect you. Let's start with what the White House is promoting, the key points they want you to notice. They're pitching this as a source of permanent tax relief, promising larger paychecks and more money in your hands. Some of those headline features look promising. An increase in the standard deduction, a bump in the child tax credit, no federal taxes on tips or overtime, and a one-time bonus for seniors. On the surface, that sounds fantastic. More deductions and less tax to pay, along with direct support for workers and retirees. However, there are important caveats to keep in mind. Not all of these benefits are permanent. For instance, the increase to the child tax credit is only a temporary measure. And that senior bonus, it's a one-time offer. Meanwhile, the tax cuts for high-income earners are here to stay. Who really benefits the most from these changes? According to several independent sources like the Penn-Wharton Budget Model and the Tax Policy Center, the biggest tax breaks will go to the wealthiest Americans. If you find yourself in the top 0.1% of earners, you could be looking at a whopping boost of nearly $400,000 a year in after-tax income. Yes, you heard that right. $400,000. But compare that to someone making under $30,000. Research from the Joint Committee on Taxation indicates that members of this group might actually see their taxes increase by the year 2029, experiencing an increase in their average tax rate of over 50%. So how can this be possible when the bill claims to cut taxes? Here's how it shakes out. Much of the revenue lost due to tax cuts for high earners is offset by cutting funding for safety net programs like Medicaid and SNAP, food assistance. By reducing or eliminating these benefits, the government saves money, but at the expense of those who rely on this assistance. Think about it. If you're a working parent depending on the child tax credit but also on Medicaid or food assistance, the extra money from the credit may not be enough to cover your losses. Plus, while you might enjoy a temporary tax break now, those benefits might disappear while cuts to assistance remain. Let's also consider tariffs. While they aren't directly part of the tax bill, they form a key part of Trump's broader economic strategy. Tariffs, particularly on Chinese goods, could mean many everyday items become pricier. When combined with limited access to benefits, even a small tax refund can quickly vanish. Now onto a hot topic, no taxes on tips. If you've worked in the service industry, you might see this as a win, and for some, it certainly is. But here's the catch. If you don't earn enough to owe income taxes to begin with, the removal of taxes on tips won't help you. This affects a significant number of tipped workers, about 37% based on Yale studies. Additionally, this change doesn't affect payroll taxes that come from your paycheck and are used to fund Social Security and Medicare. So even if you're a server making decent tips, the average benefit here is only about $1,700 a year, not a life-altering sum. Meanwhile, implementing this policy could cost up to $40 billion over 4 years. This begs the question, who truly wins in this scenario? Let's shift our focus back to business owners and the ultra-wealthy. The bill features several aspects that continue to favor this group, such as reduced estate taxes and new deductions for business income. These perks aren't temporary, they're designed to stick around. Supporters of the bill argue that tax cuts for the wealthy will spur growth, create jobs, and ultimately raise wages for everyone. This was the same argument used for the 2017 Tax Cuts and Jobs Act. And while we did see some growth and wage increases back then, many of the benefits still ended up with corporations and the top earners, while the deficit ballooned by nearly $2 trillion over the next decade. Now let's tackle an important question. How do we pay for all of this? The Congressional Budget Office estimates that this bill will significantly increase the federal deficit. Some members of Congress are already pushing back due to the disconnect between spending cuts and the bill's promises. In fact, 5 Republicans sided with Democrats to block the bill from moving forward in the House Budget Committee, an indication of internal disagreements. Others are looking to cut Medicaid further, while some want to enhance tax deductions for folks in high-cost states like New York and California. The Senate remains uncertain. Some senators, like Josh Hawley, have expressed concerns about the cuts to social programs, which could risk alienating voters who depend on them. So, where do we stand? We find ourselves in a unique moment where the bill claims to offer relief, but the benefits are distributed unevenly. If you're wealthy or own a large business, you're likely to be just fine. Conversely, if you're on a fixed income, work a lower wage job, or rely on public assistance, the future may feel precarious. This debate isn't merely about numbers. It's also about the kind of society we want to create. Should our focus be on cutting taxes for high earners with the hope that the advantages will trickle down? Or should we prioritize a strong safety net that supports individuals and families in need? These are complex questions, and while there may not be easy answers, staying informed, speaking out, and voting according to what matters most to you and your family is essential. Before we wrap up, I want to take a moment to share something valuable, an opportunity to connect with Chapter, a service we trust for clear and honest Medicare guidance. They can help you compare Medicare plans in your area and potentially save you money. Most people save around $100 a year. Their service is free, and their care advocates will be there to support you even after you've signed up. You can call 615-639-1937 or visit askchapter.org/money. I'll also drop the link in the comments below. All right, let's keep going. Like all policies, this bill comes with trade-offs. Understanding what you gain and what you risk is vital to forming your stance. So, what are your thoughts? Do you feel this tax plan is beneficial, harmful, or maybe you're still on the fence? I'd love to hear from you in the comments. I read every single one. And if you found this breakdown useful, don't forget to subscribe for more insightful discussions about the policies impacting your finances. Thanks for spending your time with me today. Whether you're analyzing your paycheck, contemplating your retirement, or just trying to understand all these shifts, I hope this has provided some clarity on what's happening. Stay safe, stay informed, and I'll see you next time.